Welcome to week four's first lecture. Last week we saw how consumers make optimal intertemporal choice uh, and decide the optimal savings. One thing that we can clearly say is that given the choice, such a consumer will prefer an endowment with a higher present value than a lower one. While he or she makes the optimal savings decision, he or she gets to choose which financial asset to buy to maximize the present value of the endowment. The question is, how much should the consumer pay for this asset? It turns out we can use the concept of present value to figure the price of a financial asset or a financial security. In this week, we will start with a simple case of a world with certainty, and then we will move on to the more realistic case of uncertainty in rate of return on financial assets or any other asset. So, let's start with the definition. What is a financial security? In the first couple of weeks, we looked at financial security as a claim to income generated by capital, physical capital. So, a financial security is a financial instrument that promises to deliver an income stream. Example, a security, for example, that pays $M1 at the end of year 1, let's say. Maybe M2 at the end of year 2 and M3 at the end of year 3. Let's assume that this financial security has a value of 3 years. At the end of 3 years, the financial security uh, ceases to exist. The question is, what is the most that should be paid now for this security? So to figure that out, think about what this security actually is. This security is equivalent to the sum of three securities. The first security pays only M1 at the end of year 1. The second pays M2 at the end of year 2. And the third pays M3 at the end of year 3. Of course, from our discussion from last week, we know that we cannot just add M1, M2, and M3 and say this is what we have, the total amount that we get from the security. Money today and money tomorrow is not the same. So, when we want to add income streams that occur at different periods of time, different at points, at different time points, we will have to take the present value of those securities. So, what is the present value of a security that pays you M1 at the end of 1 year from now? So, that would be M1 divided by 1 plus R. What about uh, the present value of a security that pays you M2 uh, after 2 years from now? Well, at the end of 1 year, the present value of that security would be M2 divided by 1 plus R. Today, the present value of M2 divided by 1 plus R would be M2 divided by 1 plus R divided by 1 plus R, which is M2 divided by 1 plus R squared, and so on. So the present value of the security or all the financial payments that you're going to get from the security is the sum of these present values, which is M1 divided by 1 plus R, M2 divided by 1 plus R square, and M3 divided by 1 plus R cube. So the maximum that you would pay for this security cannot be greater than the present value of this security. So the price of this security would be the present value of the security, which is given by the sum of all these three terms. So here we have used the concept of present value to figure out what is the price of a financial security, and how much you should pay for it. So this is your first introduction to asset pricing. The only thing is that here there is no uncertainty about how much you're going to get at the end of the 1 year, how much you're going to get at the end of the third year, or there is no uncertainty about R, what is the rate of return that you're going to get. In the real world, the rate of return might also change. But let's put that aside for now and think about how to value securities which have somewhat certain return. So let's think of a bond. A bond is a special type of security that pays a fixed amount of $X for T years. So let's say that if a bond is of 3 years, for example, uh, as it was in the earlier example of the financial security, then it will pay you something like, let's say, $10 every year. And then at the end of the 3 years, it will pay you back the face value, which is the original amount that you paid when you bought the bond. That's essentially is the loan that you have given to the institution that issued the bond. It could be a government, it could be a corporate, and so on. Again, we ask the same question: what is the most that should now be paid for such a bond? So let's use the logic of the present value of financial security that we saw just now to figure this out. So at the end of the first year, you're going to get X dollars. At the end of the second year, you're going to get X dollars again, and so on till T minus 1 period. At the end of T minus 1, or basically in period T, you get your the original sum back. So what is the present value? We just extend the same logic that we used before to any period that we can or that we want to. So the present value here would be uh, the amount that you're going to get at the end of the first period, which is X divided by 1 plus R, plus the amount that you are going to get at the end of the second period. So here we have two calculations to make. So we figure out at the end of the first year, what is the present value of the sum of X dollars that you're going to get 1 year after. So that would be X divided by 1 plus R. And then the amount that you're going to get at the end of the first year, which is X divided by 1 plus R, has to be calculated, or its value has to be calculated today. And therefore we divide it by 1 plus R again, which basically makes the denominator as 1 plus R square. The same logic we can extend to any period. And therefore, for whatever period that you are looking at, 1 plus R would be raised to that period as the power. And then we will divide the amount X to get the present value. And then you have F, which is the total amount that you're going to get back, which is basically the original value you paid for the bond. So when I add this, I get the present value of all the income stream that I'm going to get from the bond. I should not pay more than what the income stream I am looking for over a period of time. And therefore, the price of this bond would be the sum of all these payments. Only we are adding them today, so we are taking the present value of all these payments. Notice one more thing. The same amount, X, if I get 5 years from now, its importance in the total sum is going to be lower for X, which I'm going to get 2 years from now. Similarly, its importance is going to be lower than the amount X that I'm going to get at the end of one year. So the present value also tells you that the farther the payment that you have, the lower would be its weight in the total sum or the present value that we are going to calculate today. So let's look at an actual example. Suppose you win a state lottery. The prize is $1 million, dollars, but it is paid over 10 years in equal installments of $100,000 each. What is the prize actually worth? So we basically do the same logic. We calculate the present value. The only thing is that the income stream here is for the 10 years. So the last term in this present value calculation will be divided by 1 plus the rate of return raised to the total number of years, which is 10. If I do the calculation, the present value of this would be 614,457. So that is the actual present value of the price. And so if this was uh, a bond that promises you this kind of payment, then you should not pay more than 614,457 for as a price for this asset. Now notice this is world of certainty. So we have specified not only how much amount you're going to get every period, which is the usual case for a bond, but we also have specified what the rate of return is going to be every year. In the world of uncertainty, this would not be known uh, today, and and therefore you will have to use expected values of the rate of return over a period of time. But for now, this is the world of certainty, and therefore we can easily add and calculate the present value. An interesting case is of a console. A console is a bond which never terminates. It just keeps on paying you X dollars per period forever. So a console can be passed from one generation to another because it never expires. The question is, how much would you now pay for such a bond? Well, the logic that we have used up till now says that you should not pay more than the present value of all the income stream that is going to be generated by this financial asset. Now, in the earlier case, we looked at an arbitrary period T, 10 years, 20 years, 30 years. But here, the period is forever. It turns out that if I keep on adding present value, if I keep on adding discounted sums over a period of time forever, I had to just repeat this calculation for infinite number of periods. It turns out this becomes a geometric series. And a geometric series which goes for infinity has a simple representation. Its present value is just the amount that you're going to get every year divided by the rate of interest. So, how much is the present value of a console? Let's say that if R is 0.1 now and forever, then the most that should be paid now for a console that provides $1,000 per year is $1,000, which is the payment every year that you're going to get divided by the rate of interest, which is 0.1. So you should not pay more than $10,000 for this particular console or this particular type of bond, which keeps on paying you $1,000 forever. All right, so before we go on to the next part of this week's lecture, uh, complete quiz 1 and make sure that you have followed through the lecture and you have got the concepts, because we will use those concepts repeatedly for the coming lectures. So in the next class, we will talk about market for such assets, not only financial, but any kind of asset, and how to figure out the price of these assets. Thank you.